Hey there, Brad Casser from GreatOptionTradingStrategies.com. I've got a quick little video for today that I think you might find useful, and it's on a topic I've covered a little bit before, but one where I want to put together a lot more resources. And that's the topic of using basic technical analysis to help you improve your option selling results, whether you sell cash secured puts or covered calls for income. Now, don't let your eyes glaze over, because my take on technical analysis is going to be a little different than you might expect. I think it's common sense and pragmatic, but I'll let you be the judge. Before we get into the actual trade and the basic technicals that informed us in setting it up, I just want to let you know that I've added links in the description to a few other videos and playlists that go into more detail on some of the concepts we'll be talking about today. So if you want to explore some of those concepts in more depth or maybe from a different angle, be sure to check those out. And while you're down there, also be sure to check out all the other option trading resources and perks I have for you, including a new feature I've added to my very long-running daily option tips and insights newsletter. I now periodically share official Leverage Investing Club trades with non-club members in real time via the Daily Tips newsletter. More details down there. Okay, back to today's video on using basic technicals to improve your option selling results. Now, at one extreme, there are those who treat technical analysis as though it were a crystal ball. They look at a chart and then confidently tell you what's going to happen in the coming days, weeks, or even months. Then there are others who are deeply skeptical. They just shake their head and say, it's all a bunch of horse shit. My take? Technical analysis is not a crystal ball. It does not tell you with any certainty what will happen. It's much more like a weather vane and a barometer. It tells you which way the wind is blowing and gives you heads up regarding potential changes in the weather. Or as I like to say, it tells you what's more likely to happen in the near term and what's less likely to happen. And yes, it can be subjective, and the less likely, even the totally unexpected, can still happen. But another good way to think of technicals is that they provide a visual representation of current factors in investor psychology that are currently at play in the market or with a specific stock. Okay, with that said, let's look at how we use basic technicals to select a current put selling trade we have on PLTR, which we entered on Monday of this week and which is scheduled to expire at the end of next week. We'd actually just closed the winning put selling trade on PLTR that previous Friday at the $130 strike price, which is where support is drawn in here on this chart. But instead of rolling that position out, I decided to exit it and treat the following week's trade as a separate trade. That's partly because I plan to drop the strike price down from that 130 strike to 125. But it's also because I wouldn't know whether I actually wanted to enter the trade until I saw where the stock and the broader market was trading or behaving when the market opened on Monday. And this is where the technical analysis comes in. As you can see very nicely in this chart, PLTR has been forming what's called a descending triangle, where you've got solid horizontal support right around the 130 mark, but you've also got a series of lower highs. That's considered a bearish pattern, which makes sense because it signifies that sellers pushing back buyers at lower and lower prices. But I think a better way of viewing a triangle or a wedge type formation is that there's inevitable showdown between buyers and sellers where the outcome is still uncertain. In other words, both can't win, but one likely will. And usually when these showdowns occur, it's a pretty definitive victory or loss for one side. Now, while I think PLTR is one of the most badass companies in the world, and they just posted blowout quarterly revenue and earnings growth numbers, and while the stock is no longer trading at the nosebleed levels that it had been, it's still richly valued, as they say. So it's a very real possibility that the impending showdown between buyers and sellers ends with sellers regaining the upper hand and we see another leg lower. My personal bias is that showdown, that descending triangle, gets resolved to the upside. But again, I don't have a crystal ball. What I do have is a chart giving me a very obvious warning sign that the odds are going up of a big move in the stock in one direction or the other. So we didn't sell our puts at support at the 130 strike price. We sold them below support at the $125 strike. And here are the numbers and the details. So with PLTR trading at $134.67 on Monday, May 18th, 2026, we sold May 29th, 2026 $125 puts for $1.28 a contract. Now after commissions and fees, that worked out to be a pretty terrific 33.86% annualized rate projected over the following 11 days until expiration, and that's on real cash secured capital. In general, we target 15 to 25% annualized on new trades, so I consider these terms to be fantastic, especially at that lower strike price. Now this is important. For covered call riders, the same trade could have been constructed with a $125 buy right covered call, meaning you buy the shares at that $134 and change share price and simultaneously sell or write a $125 covered call. There can be some subtle pricing differences between calls and puts, but both constructions of this trade The $125 short put and the $125 covered call want the same thing, for the stock to continue trading above $125 a share between entry and exit. And the gains from both versions of the trade are derived from the same thing, the dissipating time value on their respective options. I've added some links in the description if you want a deeper dive and to see more examples, but providing we're talking about the same strike price and the same expiration date, an out-of-the-money short put and an in-the-money covered call are basically the same trade. But for the trade itself, to summarize, the $125 short puts still paid out a really nice amount of premium. I felt it also gave us a decent downside buffer in case that $130 support level broke. And in the event that the stock trades below $125, we'll be in a much stronger position to manage and repair the trade from that lower strike price. And factoring in Palantir's elevated implied volatility option pricing, any repairs we need to make should be pretty easy and straightforward. Now, I don't want to go down some side street on trade repair in today's video, but the reason we have a 98% long-term winning rate is because of our highly effective and reliable trade repair process, the 4-stage trade repair formula. If you want to learn more about repairing trades so that you walk away with more money than you start with on virtually any put selling or covered call for income trade, check out my option selling trade repair playlist. And I've added a link to that in the description section as well. Okay, obviously this trade is still open, so let's plan for a follow-up and see how everything works out and who wins the showdown between buyers and sellers. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. The channel is really starting to gain traction, and we recently blew through the 1,000 subscriber milestone. 2,000 subscribers, here we come. And I've also got a lot more option trading videos in the works. Also, as I mentioned at the outset of today's video, if you'd like to periodically see actual Leveraged Investing Club trades in real time, not just after the fact, be sure you're signed up for my free daily option tips and insights newsletter, because recently I've started including daily tips readers on the occasional club trade. That includes sharing a PDF version of the trade idea right after I put it together and post it inside the Leveraged Investing Club. I call these Leveraged Investing Club open house trades, and it's a great way for non-club members to get a glimpse into the Leveraged Investing Club, our trading approach, and to see firsthand how effective and profitable that approach can be. And in addition to the original trade idea, usually posted over a weekend, I also include daily tips readers when I send out real-time trade alerts, which I do anytime I enter a trade, roll or adjust a trade, or exit the trade. And then the fun part. After the trade has been closed, I put together a full case study that includes the original write-up, all the trading activity, any commentary I added along the way, and a breakdown of what I feel are the most important lessons or insights the trade has to teach or reinforce in us. To date, we've successfully concluded one open house trade, and we also have another one that's still open. And the one that we closed was a really lovely trade on T. Rowe Price, even though it did misbehave a little bit. But still, we walked away with a very nice 20.06% annualized ROI over 65 days, which I've compared to investing in a 2-month CD with an APY of 20%. Now, obviously, these trades aren't FDIC insured or anything like that, but I would point out that it's extremely rare that we ever book a loss. Again, primarily because of our highly effective trade management and repair process, which is based on the magic of basic math and a healthy disrespect for crowd psychology. In any case, I've added a couple of open house trade links below for you to check out. One is a link to download the 12-page case study on that T. Rowe open house trade, as well as a video that breaks down the T. Rowe trade and the entire open house trade process. Okay, until next time. And remember, heads we win, tails Mr. Market loses. That's our mantra and reality inside the Leveraged Investing Club, and it can be yours too.